We are now officially in La La Land.
Mm.
This is the old tried Buffett ratio, and now we are back over 200%, which we've never had before. Fact is, though, this market ain't cheap. I think this is just a simple recognition of what that is. And when I say not cheap, the top three stocks combined market cap is $10.5 trillion, and they have a blended price to sales ratio of 19.
Yes.
That's mad. Okay.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When Sven Henrich of Northman Trader was last on this program in July, he shared that he had just closed out all of his longs and moved to cash. Well, that move paid off as the S&P fell over 300 points in the following next few weeks. After that, stocks rebounded and have powered higher up to today, now back near their all-time highs. So, what does Sven's technical analysis tell him to expect next, especially with volatility elevated both in stocks as measured by the VIX and in bonds as measured by the MOVE Index? To find out, we'll now hear from the man himself. Sven, thanks so much for joining us today.
Hey, Adam, great to be back with you.
Hey, it's wonderful to have you back. I love the new setup. I love the jacket. All right. Well, look, lots to get into. As I mentioned, I wanted to just give you kudos for the timeliness of your analysis. The last time we talked back in the summer, you pretty much predicted the late July, early August swoon perfectly. Hope you made some money for yourself and your clients off of that. Obviously, we got a lot of big things coming up here. We got an election in just a couple of days here in the U.S. We got a new year coming up. Want to get into all that as well as some of your charts. Really quickly, though, just to set the stage, let me ask you my general opening question, Sven. What's your current assessment of the global economy and financial markets?
Well, thanks for the introduction, Adam. Yeah, the August thing was quite amazing. I mean, we had, as you said, closed out in cash, which was kind of a risky move for us because you just, these things can always melt up. But we just didn't like the risk reward to the long side at the time, and that was perfect when it happened and gave us a new entry opportunity. By the way, people are still confusing as being a perma bear. We're trading long only, and for us, it's buying dips and corrections and then scaling out when we are seeing these big aggressive rips. In terms of your main question here to start with, look, as you said, we have an election coming up on Tuesday. The most contentious election in U.S. history, I'm hearing. Both parties are saying that if the other side wins, democracy ends in America.
Mhm.
We got North Korean troops lined up in Ukraine ready to aid Russia, and then we got Iran apparently ready to attack Israel from Iraq. We now turn to our next guest to tell us why World War III is bullish.
Okay.
That's kind of the general setup we have here in terms of sentiment. It's quite amazing. I want to refer back to a discussion you and I had at the very beginning of the year. That's when I published the Cynic's Guide to Markets. And
Mhm.
in the Cynic's Guide, we talked about a 10-year cycle, and there were some questions raised in it. One of the key questions was, can you even have a recession with a just enormous stimulative government fiscal deficit running? In 2023, it was $1.6 trillion. And lo and behold, this year it was 1.8 trillion, and debt increased $2.2 trillion in just 12 months. And the question I asked in the Cynics Guide in January was, am I being too cynical? Basically, it's just saying that this is going to overpower everything else in terms of concerns. And the answer is now, I was not cynical enough based on what we've seen. It's absolutely incredible. Um, and so my contention this year has been a lot that what we're seeing maybe in terms of economic growth is highly overstated in terms of vis-a-vis what we're seeing in the organic economy. But it keeps driving, and it's a matter of liquidity. That's you and I have been talking about this for a long time as well. Let me just throw in one little quick chart. Okay, this is just basically financial conditions. Okay, financial conditions have, in essence, been easing ever since the late 22 period. I mean, this is, the high bond yield ratio that I use as approximate for financial conditions. Bloomberg uses this as well. It's quite helpful to understand. The tightening cycle, for all intents and purposes, was over in this time frame. And here we had the banking crisis, and we know there were interventions and liquidity backstops. Last year we had this correction, things tightened up a little bit, and then just ripped up higher. And guess what? Into October, from that August push down, we got to the even looser financial conditions than we had prior to the Fed raising rates and ending QE. You got to really appreciate that in terms of the impact, because you have two trains running. You have the Fed on the one hand saying monetary conditions were tightened, right? We've been on a tightening cycle. On the other hand, you got the US government issuing tremendous amounts of debt. Fiscal deficits are historically stimulative, and they're bullish asset prices. So the net effect, as we saw in financial conditions, was easing, ever further easing. Hence, what we're seeing in terms of asset prices makes total sense, right? They just love easing financial conditions, and that's what's been running.
Right.
So
Hey, and Sven, if I can just add two other things. I mean, there's even more than this, but yes, fiscal has been pouring gasoline on the stimulative fire. Um, but even though the Fed was hiking interest rates, um, there were two things it was doing that were stimulative. One, those higher interest rates, to a certain extent, were stimulative to the economy, to everybody that was, loaded up in T-bills, right? All investors that were loading up in T-bills are suddenly getting a 5% return on their dry powder capital, whereas years before they were getting almost nothing, right? So that actually was a stimulus back to that investor crowd. And secondly, they were draining the reverse repo program, right? Which, when you're increasing the reverse repo, it acts like a sponge taking liquidity out of the system. But when you're draining it, and the reverse repo program got up to what, like $2 trillion,
and
they were
now
draining.
it's about 150 billion today. It's heading towards zero rapidly.
Right. So almost all of that 2 trillion has been coming into the economy or into the system while the Feds had those high rates. So even though it looked like they were quote unquote tightening, there's a lot going on behind the scenes that they probably, even just the Fed alone itself, might have been net easing.
Well, absolutely. I mean, it's not only that, but you also had liquidity backstops. I mentioned the banking crisis in 2023. That provided a big liquidity backstop. Even this year, I mean, the Treasury Department came in with buybacks, and they were really clever, because issuing this much debt is not easy. And Janet Yellen and her team have been, got to give them credit. They've been extremely effective in doing that. And for a while, obviously, we saw this big relief in yields that has aided the the asset price equation. But things got really funky here in the last few weeks, and I want to explain why. But before I do that, I want to show, and this is an educational chart for me, and I hope it's an educational chart for everyone. It's kind of called it the theory of everything. Okay, this is pretty wild, right? Because I think everybody, and this kind of sets the stage also, maybe how we can all think about what's happening in 2025, with some caveats that I will also discuss. But here's a chart called the theory of everything. Okay, and
Mm-hmm.
this theory of everything just kind of gives you a sense for the last 10 years. Okay, can you see this all right?
I see it just fine. Yep.
Okay, so let me walk you through this. Theory of everything says basically we've been in several policy-driven super rallies in the last 8 years. Okay, first of all, here, so you may recall, we had an earnings recession here in 2015. What happened at the tail end of this? We got global QE. This is when Draghi, ECB, and other central banks started following the Fed script, and they all introduced QE. We had obviously the presidential election. Trump became president. We had corporate tax cuts. It was one of those rallies, and I call them super rallies in the sense that they just go on and on and on and on. And there's hardly any pullbacks. You get the monthly 5 email reconnect. That's it. Everything's a buy. Okay. And then all that stopped when What happened? Fed raised rates and QT was introduced. Remember, we had also a 20% drop here at the end of 2018, right? And then what happened? We know the Fed flip-flopped, they cut rates, and the balance sheet was expanded again. And we had another one of those rallies that goes on and on into basically the beginning of the following year. Then we had a drop, which was, we all know was an event. It was COVID driven. And then we had super QE and fiscal stimulus and everything went wild. And we know what happened, right? We had rate hikes, and that produced that so-called bear market in 22. But as I just pointed out, with the easing of financial conditions, fiscal dominance, liquidity backstops, we're back into one of those super rallies. I mean, we basically every 5 email reconnect again is a buy. We had a little blip here in August. That was the 10 MA on the monthly, and here we are again. You know, everybody now expecting a year-end rally. I could say it's maybe a little ironic because right here, everyone published from Wall Street, you know, year-end targets for 48.50, and here we are near 6,000. Everybody's talking, yeah, we're going to go to 6,000 plus. What I want to make, the point I want to make is severalfold. First of all, these big rallies, all of them, policy driven. If you got liquidity behind your back, it's positive asset prices. The only time really asset prices get hurt is when the liquidity equation changes. I mean, it's literally here and here. That was it in the last 10 years. Everything else was bullish nonstop. And of course, you know, if you have an event like, you know, this was obviously unpredictable, but it was an event that happened. So we got to recognize the next point, which is when did these stop? These stopped when liquidity was reduced, right? And what's the expectation here? Because, you know, these went on to the end of each of those years. And then we had a shift in policy regime. Well, what can we expect going forward into 2025? Well, we already know what we can expect. Rate cuts, global rate cuts. They already started, right? That is supportive. In fact, you can imagine we're going back into a regime that we saw following 2009, which is every time there's any corrective trouble, they're going to cut rates more. They have awesome firepower at their disposal. Point one. Point two, you know, these fiscal deficits are not stopping, and they won't stop because they can't stop. The mandatory spending that is on tap is just ungodly in terms of going forward deficits. The CBO itself projects 2 trillion plus deficits as far as the eye can see without a recession. So we're all kind of, you know, first understanding that liquidity has been driving all this, fiscal dominance has been driving it, and fiscal dominance will continue. In fact, the Treasury Department this week just announced, you know, they're going to add another $1.4 trillion in Treasury bonds issuance this quarter and next combined. I mean, these are just unfathomable sums of money. This is going to continue, right? And so on that basis, you can basically just throw up your hands and say, well, this is just going to keep going, okay, into 25. Unless there are some hiccups. And I actually expect hiccups in the meantime. Because, for example, the reverse repo facility, as you mentioned, it's actually draining towards zero here fairly rapidly. And that can cause a liquidity hiccup, which may ironically force the Fed to go back into QE. So I'm saying if there's any hiccups, the policy tools are there to save everything. So I just want everyone to be aware that going into 2025, there is going to be not only tremendous liquidity support on any issues, but that they also have enormous firepower at their disposal. Okay, so this is just unfortunately reality that markets for years and years and years have been increasingly managed in a policy type fashion. In fact, we just saw this in China, right? I mean, the Chinese have literally come out and, you know, throw in a bunch of stimulus, and they're going to issue even more apparently in the next week or so, fiscal stimulus and cutting rates with the express purpose to incentivize consumer spending and to boost the stock market. I mean, they're literally saying that, right? And that is also part of the global liquidity equation. It's upon us again. I hate to say it, but it's just part of the reality that we're dealing with in how to assess markets. And if we as investors and traders are not aware of that, like in 23 and 24, if you were fighting all this, you were pulling your hair out, right? As a lot of people have done. But that's what's been controlling, from my perspective, this entire market equation for the last, years since 2009, basically, right? But especially here in the last 10 years. But let me also make one more point on that chart, because all of this is coming with tremendous consequence. Actually, let me pull that chart up one more time, because I think there's a key point here I want to make. That first super rally I talked about here in 2017, just so everybody has perspective on this. This was the year when one company, for the first time in history, managed to get a market cap of over $1 trillion. That was Apple, right? And here we are, just literally 7 years later. We now have 3 companies with market caps in excess of $3 trillion, $3.5 trillion. And not only these market caps, but they have enormous valuations associated with them on a forward basis. Apple's at 27, 28 PE, Nvidia's 34. I mean, these are not small companies, right? I mean, you talk about growth stories, sure, we can discuss all that, but there is little room for error in all this. My larger point in the Cynics Guide was too that markets have become so large and so important in terms of the global economic and financial construct that policymakers are literally managing the economies with policy, i.e. what the Chinese are doing. We're going to incentivize, we're going to get the stock market up to boost confidence. And so the danger is here that, we disconnect markets ever further from a global fundamental construct. It's the ultimate bubble risk. But as long as liquidity remains in control, there's no limit to the absurdity we can observe. It's just, we've gotten to a very strange place here.
So this topic has come up several times on this channel since you first delivered your theory of everything when you were back on earlier, Sven. And I've had Michael Howell on the program a couple of times. He's publishes at Capital Wars. He's an old hand from Salomon Brothers, and his big focus is liquidity. And I find myself sometimes on this channel throwing up my hands and saying, does all the other stuff we talk about really matter, or should we just look at liquidity because it really seems to determine so much, as you've been saying here? And so I want to just build on your chart really quickly here with a chart from Michael Howell. Michael Howell tracks global liquidity. He notices that it goes through, it generally acts in a cycle, and your chart sort of shows that, right? We have run-ups when liquidity is on, we have corrections when liquidity is off. And the cycles are roughly 2 years-ish. And anyways, you can see here that the current cycle bottomed at the end of 2022, and no big surprise, that's when markets bottomed, right? And it's been turning up since. This chart here is a little bit older, so we're further along in this path here. But basically, he says this current cycle doesn't peak until the end of 2025, beginning of 2026. So to your point, we should continue to expect a tailwind to be at financial asset prices back between now and then. But, and there's an important but, just like when you throw a ball up in the air, the impulse of its rise slows as the ball approaches its apex, right? So the tailwind will get less strong as we go in through 2025 in general, as we're getting closer to the peak. But secondly, he said that one of the things that he's really going to be watching closely, because it can really impact global liquidity, is the wave of corporate refinancings that are due to happen in 2025. You know, we had a lot of headlines about this in 2023 about the corporate debt maturity wall, and it kind of fell out of the headlines. And a couple of reasons for that. One is, you know, companies loaded up on the cheapest debt they could get right as the Fed was starting to hike rates. So they've been living on borrowed time. And I think they've been able to do, you know, some restructuring with their lenders a little bit to stave off the worst of the refinancings that have happened so far. But Michael's concern is hey, when we get into 2025, that's going to really start happening in earnest. And those corporate refinancings, when debt re-rates at a higher yield, and quite honestly, a pretty substantially higher yield than what the average corporate debt on the balance sheet is, that's going to act like a sponge. That's going to start really sucking liquidity out of the system. So that might be one of the additional shoes that could drop in 2025. The hiccups, as you said, that could be added to the list potentially.
Well, let me add a couple of things.
Sure.
By the way, before I sound all just super bullish forever and ever, I have some bear porn charts for everyone as well. So I'll
Okay, good.
save those for a little bit later. But in terms of what you just mentioned, what I just mentioned in terms of liquidity, I want to just highlight one more point about the Cynic's Guide to Markets, which was the whole premise was about the 10-year cycle, with year 5 of the cycle being also very bullish and bringing in new highs and so forth. And in the guide, we talked about 2024 being, you know, basically any dip is a buy. And so far that's been playing out, you know.
All right.
And
And
some of
sorry to
these,
interrupt, Sven, just so I'm remembering correctly, is 2024, is that sort of year 5 in the current
no,
10-year
it's the
cycle?
4th year. It's
It's the
literally a
fourth year.
10-year
Okay.
cycle, starts at year 1, goes through year 9. And for some reason, historically, and I outlined basically decades worth of charts there, for some reason, the 5th year is always creates new highs, and sometimes very dramatically so. And some of these year 4s are, you know, maybe very choppy, but some are very bullish, but they all kick into year 5, showing more highs. And just today, I was just looking at this article again because, you know, I like to sometimes check on what I'm actually writing, how it stacks up, if you will. And I looked at these decades comparisons, and I just one immediately stuck out to me, and I had to just overlay. You know, what happened here now between 2023 to 2024. Now, analogs always cautionary, always problems, but I want to show you this. This kind of freaked me out a little bit, okay? Because it's you know, we're talking decades ago, 1963 to 1964. How is that even relevant, right, to today? So let me show you the comparison I threw up. And basically, I wouldn't call it absolutely day by day, obviously, but you know, here's you know, 2023, here's 1963 bullish out the gate. We had
Wow.
that was the banking crisis, then a big up, which is also what we got. Then we had a pullback, but the timing is off here a little bit, you could argue. But you know, last October we had that low. Guess what? They had it in November, and then a massive big up. The point was year 3 was going to be up, year 4 was going to be up. And then look at this year. You know, we had this August pullback. Well, guess what? They had one here too. And then it pushed into new. Here's the August pullback in 1964. We had one here. I mean, it's basically almost aligning perfectly. And then the message was, you know, September, the bearish month of the year, it just went higher, right? We had like 3 or 4 days down here and went to new highs. That's the point. Just new highs into October, November of the 4th year, and that's what we just saw. And if I use this as a general kind of a template, you know, knowing things can always turn out differently, I want to show you how this actually then ended up playing out, which, interestingly enough, you're not going to believe it. uh,
All right. I'm already pretty spooked out as to how correlated those were.
oh, it's pretty freaky. In that year, that's kind of the November high. We, you know, October, November high, and then we had a pullback still in Q4. Not a dramatic one, 5%, but guess what? We just had a 3% pullback, right?
Mm-hmm.
From the highs. And basically, we just going by that template, it says, it's whatever pullback we get is going to get bought for new highs. Guess what? The end of the years, then some chop, and then another rip higher. And then the first sizable correction in the middle of the fifth year. 12% back then in 1965. And then guess what? Another rip higher to ever more
New
highs.
highs.
And
Yep.
I can look at this and say, well, okay, it's a completely different decade, but I can look at this now in terms of the liquidity cycle that we're currently in, and I can and we can talk about the election risk factors here in a minute, and certainly there are plenty, and maybe you get a larger pullback perhaps if something goes really wrong with the election, which we hope all, I presume it won't happen. But, you know, whatever low there comes would likely get bought because the liquidity equation continues to be favorable. And guess what? In what happens in 2025, we know one thing that will happen. In the last 2 years, they all ran with an unlimited credit card. The debt ceiling was suspended, right?
Mm-hmm.
And in 2025, it comes back. Why is that initially bullish? Because the Treasury has built its TGA account with over 835 billion are currently in there. And as we get back into a new Congress and new discussions about the debt ceiling, which will kick in again, the Treasury will have to drain that. And guess what? In a perverse way, that adds more liquidity to the market. And let's not forget, we also have record buybacks, right? $1 trillion worth of authorization in buybacks. So you can make the case, yeah, this makes total sense that we're going to see more liquidity driven up into next year. And then I can even imagine that depending on how Congress is set up, that we may get some sort of debt ceiling scare again. And then we know what the outcome of that debt ceiling scare ultimately is. They're going to kick the can again and everything is fine. I'm just throwing this out there as a complete speculative bone, but my point is
Mm-hmm.
what we've seen here in the last couple of years is eerily similar to what we saw in the 1960s. But if you look at the original article in terms of what the message of the 10-year cycle was, it all still fits. Now, I can argue maybe that some strange things have happened this year in terms of an exaggeration. Maybe a lot of the gains got pushed forward. And this is where I kind of want to talk a little bit about mechanics as we're now dealing with, I would argue, maybe a little bit unusual behavior, what we saw in markets in the last few weeks, right? Typically, September, October in an election year is seasonally weak. Clearly, that's not what happened this year, right?
Mm-hmm.
Not until maybe in recent days. Okay. So I talked about the debt spending. Something really funky happened, and I have no explanation on this. And no one's asked Janet Yellen because I guess no one bothers to ask the pertinent question. But that's this. The fiscal year ended for the US government. They were on a kind of steady track with some pausing here, but as we know, massive debt expansion this year. And all of a sudden, at the end of September, we saw a massive spike into October. And this number is already outdated. It shows there's $35.75 trillion. It's already at 35.85. So that's another 100 billion. So we're talking 600 billion. That's over $500 billion in debt added in 4 weeks.
Yes.
Explain this to me. Why now to this extent? If this is all stimulative, I hate to be the conspiracy cook here, but we've seen the Yellen factors one too many times. And the reason I find all this bizarre is because of this. We've had long-standing relationships in markets, correlations of how asset prices work vis-a-vis bond yields, and the US dollar, right? And all of a sudden, all of that died uh, in recent weeks. It made absolutely very little sense whatsoever. And I'll show you here a correlation chart that I have. The S&P here is expressed as an inverted function. That's how I get the correlation. I mean, it's been fairly, there's always variations. We had this little hiccup here in August, but they always kind of track along the same path if it's, if the S&P is inverted. And all of a sudden, as that massive amount of debt came in, that correlation just died. The dollar ripped higher, yields ripped higher, and the S&P just simply didn't care. I mean, I cared yesterday a bit, Thursday, and today it's bouncing a bit. But point is, that break in correlations was very unusual. And I can't prove it, but I'm just wondering if all of a sudden you get this massive debt deluge, if that created some funky action. And when I see disconnects, I always see risks of, things rebalancing themselves in some fashion, which brings me kind of to more immediate risk factors here into the election and maybe thereafter.
Okay. And
It's
sorry, just to
yeah.
clarify, to make sure I'm getting the intimation, when you say you don't want to sound conspiratorial, but you're seeing this breakdown in these long-term correlations, to you, does that look like potentially, I'm not saying it is, but does it smell like maybe the government putting its hand on the scales to make things look a certain way going into an election? Is that what you meant by conspiratorial?
Well, I mean, we talked about this for years too, the Yellen factor, Yellen concern. You remember all the little appearances. I mean, September, we had 3 down days. Markets dropped hard in 3 days. Yellen shows up on the weekend. Everything is awesome.
Hmm.
And that was it. That was the low. Monday rip up, and September just ripped up through the rest of the month. And heck, this week, Thursday, if you look closely, S&P dropped. I'm just saying how reactive markets are to this. All of a sudden, Treasury comes out and says, "Well, we're going to do more buybacks, and we're going to buy 22 billion in securities for cash management purposes, and
Hmm.
we're doing these buybacks to improve liquidity." And then immediately markets shot up. Okay, ultimately they rolled over again. But I'm just saying, you know, we're in this really weird phase where, to be honest, I have a hard time trusting a lot of the economic data that comes out because it's always garbage 2 months later because it's getting
Hmm.
revised, i.e. the jobs number, right? I mean,
Yes.
today's NFP number came out, and I think I put that tweet out, I think in early October. I said, who's actually believing this NFP number? Well, here we are in November, and they're revising August and September down hard by 120,000 jobs, right?
Yeah.
There's a lot of that going on because they use birth death rate models and seasonal adjustments, and who really knows, and so it's just very convenient, and that was kind of the theory too in the cynics guide to say no one has any interest in a repeat of 2008 or anything like that, so they're going to keep things elevated into the election. And whether I was right or wrong in terms of the mechanics behind it, I mean, that's clearly what has happened, right? And no one's asked Janet Yellen why all of a sudden debt increased by $600 billion inside of 4 to 5 weeks. No one's asked Fed Chair Powell or any of his Fed presidents how they can claim a tight monetary policy when you got a record, well, more than a record. I mean, 2 years of record fiscal deficits running through the system as a stimulative background effect with financial conditions easing. Are you tightening with financial conditions easing? No, you're not. Who are you tightening for it? And this is, Ian and I have had multiple discussions on this whole wealth gap effect. And I got to
Yeah.
tell you, this is sick what really has happened this last couple of years, because the way I see it is monetary tightening has impacted the broader population, while through the stimulative effects of deficits and liquidity backstops, the asset owners, which we know 90% of stocks are owned by the top 10%, have received just an ungodly wealth effect benefit. In fact, even the Fed itself has published now information that shows retail sales are largely held up by the wealthy consumer. I mean, we've never seen market cap expansions of the size that we've seen in the last 2 years. I mean, it's ungodly what's happening there. And so we find ourselves in a really unusual spot. And I think this should worry everyone to some degree. Okay. And I'll show you this. And this is basically a sentiment data chart that shows how unusual everything is now. Typically, when you have a growing economy as it's being presented to us, right? 3% GDP growth and low unemployment and record asset prices. What we see in cycle and cycle again, consumers are confident, sometimes more, sometimes less. I mean, here late 90s, it was just a boom, right? Even here in the lead up to the housing crash, we had readings in the 90s, if you will, even higher. In the lead up to the COVID crash, we were back into the high 90s. You know, everything was looking better, right? And then obviously we had the COVID crash, and look at this. I think this last data point bounced back to 70, but 70, I submit to you, is typically recessionary territory.
Right.
Um,
And it's lower than the COVID low.
Yeah, I mean, it's well, because it was so fast, it didn't even have time to register because they immediately threw in stimulus and everything else. And then you can argue there's been an improvement, but I'm just saying historically, it's very poor. And I think part of the reason is obviously the consumer got really screwed here with record housing inaffordability, prices that continue to stay high. Keep in mind when we're talking about inflation, going lower, prices are still going up. They're just going up at a lower rate, and everybody's stuck with these permanently higher prices. But if you're not an asset owner, with a lot of people simply are not, you are struggling for sure. In fact, I didn't bring this with me today, but I posted on my feed about how personal interest payments have skyrocketed. Pre-COVID, they were close to 300 billion. Now they're over half a trillion a year, and the personal savings rate has plummeted. So, let's not kid ourselves. A lot of spending is still debt finance, right? Credit card balances keep going higher. And I'm just saying this is very unusual. And you and I talked about the ever increasing wealth gap from cycle to cycle to cycle. It's gotten worse again in a dramatic fashion. I think it's reflected in consumer sentiment. And that, one wonders, is a breeding ground for social instability. And that's why you kind of look at this election right now and you go, oh my God, everybody's at everybody else's throats in a major way. And does that, and I hope not, but does that lead to something really unpleasant?
Right.
Especially when you have these extreme narratives on both sides, really hyping this election up to be something really existential, right?
So, Sven, let me just interrupt you on this because you and I have talked about this at length. I've talked about it on this channel with other folks as well. So let me just ask you this. What's going to prevent us from getting to that social boiling point? Like, do you have any real optimism you can point to and say, well, it's a risk, but these things look like they're going to keep us from there? Or is this a trajectory that, you know, is going to unlikely to change and will continue to progress until you hit a critical point where enough people say, this is just not working for me. We got to do something different.
Well, first of all, let me say on the political side, everything I just talked about in terms of fiscal deficits, the wealth gap is not even discussed ever. It's not addressed in Fed press conferences. No reporter is ever asking the question. The Fed's never held accountable for it. Janet Yellen is never talking about it. And incidentally, both Powell and Yellen for years have been saying, well, these deficits are unsustainable. It's going to have bad consequences, but they themselves are, continuing to sustain that system. And what my biggest worry is the cycle here, now that they've run these big deficits, and so far there is no consequence and no recession. Politicians on both sides are looking at this going, why don't we keep going like this? Why don't we keep going like this? Because there are never any consequences, it seems. And so in this election, for example, you hear nothing about all this. And both candidates, Harris and Trump, in their own way, are promising things that by definition will raise the deficit even further. Okay. And unfortunately, if that train continues, and by the way, the CBO is already projecting debt to GDP to scream to 200%. It's over 120% now, which would have been thought of as just impossible 10 years ago. But here we are. And as I mentioned earlier, deficits without a recession nonstop. So the base conclusion has to be that the wealth gap will continue to increase and increase and increase. And I got to tell you, I don't know of any historical examples where that did not end up with something bad. And you can look through history, and when people are literally desperate or feeling behind or left out, it leads to discontentment. And many times, unfortunately, that discontentment leads to complete social mayhem. Even in societies where you would have thought that was never possible, even in educated societies that, were doing really well, you would think. Now, it's a structural concern. Can I time it? No. I guess we'll find out next week, for example. I hope to God everything goes smooth, and probably the best thing for markets and for the economy and for the society would be if there was a smooth, clean election and that was the end of it.
Right. A decisive win and a smooth transition. Yeah.
Yeah. And you can, even argue whether split Congress or super majority of one part. I don't know. I mean, I can't say, but I think it's fair to say that a lot of people are worried that this is going to be a contested election. God forbid there's violence and people doing stupid things. Hope that doesn't happen, right? But we can't know, and I guess maybe we'll find out immediately if this is a landslide for one side or the other, or if this drags on. I mean, we've seen that before in like 2000, right? This went to the Supreme Court in Florida. Who can really tell? So I hope for everyone, especially in America, this goes all smoothly. But we keep in mind, the political sentiments, I would argue, is by many perceived to be existential, because that's the narratives these parties have been pushing as well, these politicians. And a lot of people are very susceptible to that, and they get themselves caught up in that. In fact, I would even argue there's market positioning that is driving some moves where they're expecting this person to win or that person to win. Well, guess what? If they don't win of what they expect, you may see a larger unwind of positions all of a sudden, right? I mean, I don't trade politics, and I don't base my trading on a political view or preference. But if there are people that do that.
Yeah, right? Certainly some of that jockeying's going on. Absolutely. Yeah.
Yeah, I want this person to win. I think that person's going to win. Therefore, I'm buying this.
Yeah.
Okay, well, good luck. I mean, maybe you're right, maybe you're not. I'm just saying that can lead them to, i.e., these reconnects I mentioned. Right? In fact, let me just throw one chart out. just get away from the election. Well, maybe it's partially related to the election. Not a single Fed person, not Powell, not any one of his presidents, when they cut rates by 50 basis points in September. And by the way, remember when inflation was going up to 8, 9%, and they started ever so carefully with a 25 basis point rate hike, right?
Mm-hmm.
Of course, on the cutting side, boom, they go 50 right away, right?
Yeah.
Not one of them, I would submit to you, expected this to happen.
Yeah. And you're
Okay?
going to say bond yields going up, right?
Yes.
Yeah.
I mean, this was literally the bottom. This was the when the Fed cuts rates, right? And everything was bullish, right? Because yields are coming down, the big relief rally. I didn't expect this. No one did. Okay. I mean, this is not only a big move in terms of size, it's the velocity of that move. And I'm just looking at this technically. I had put out some TLT charts on my Twitter feed, which pleased to say they actually worked out really well from a technical perspective in terms of the pivot points, with divergences when they would flip. And in the last few years, yields actually have been acting very technically. I mean, this bull flag here in 22, 23 was beauty,
Mm-hmm.
right? I mean, back then already everybody was expecting lower yields, but then it screamed up to here. And boy, does this sure look like even bigger bull flag. That makes no sense to anyone, including myself, because if we're cutting rates and this, that, and the other, how can this be going up? I mean, this bull flag, if that were to play, and I always say patterns are not confirmed until they actually confirm, but that flag could play into 5.5%, which is ironically what Stan Druckenmiller thinks where yields should be. He's placed a bet on that, and so far it's a brilliant trade for him. And Stan Druckenmiller is no fool, right? So to me, then that is, if that were to really play, while markets have ignored that so far, it's not a positive. It's not a positive, and that could certainly shake things up rather dramatically. So
Yeah.
something to be aware of in our funky market universe.
So for folks that want to get more on the arguments for why yields could continue to go higher, yeah, there's been some recent statements in the news by Druckenmiller and by Paul Tudor Jones on this channel. There are two recent interviews that come to mind. One is with Luke Gromen earlier this week, and then one is maybe 2, 3 weeks ago with Bill Fleckenstein, who has long been awaiting the moment, and he's not saying we're there yet, but he's seeing the action he would expect if we were starting to enter it, which is where the bond market really shows that it's losing faith in the Fed, and it starts taking yields higher no matter what the Fed does. So anyways, if you want to go deep dives into the arguments for why yields could continue to go higher, those are two good interviews to watch. Sven, I want to get to kind of brass tacks about, okay, so with all this context, where do you think things are likely to go in the relatively near term, in terms of, if you're taking positions based upon anything that your TA is telling you in the next, 3 to 6+ months. I just want to put an ending on my earlier question to you about the wealth gap leading to some sort of social event. You're exactly right, which is there have been no repercussions so far for the policies that we're pursuing. So highly likely to expect them to continue, right? And that benefits those with assets over those without, right? And we can argue whether this is a bug of the system or a feature of the system, and I think a lot of viewers might say it's a feature, is even when this strategy, this trajectory we're on, even when it runs into trouble, right? Like, we're deforming markets and whatever, right? Even when things get out of the control of the central planners, the playbook now, which both the government wants to do and the public is cheering them on to do, is rescues and bailouts, right? What does that do? Well, the rescue actions actually benefit those with assets on an even greater scale, right? So it's like, it's great while it's working, and it's even better for you when the wheels start coming off, right? And of course, the public is just saying, "Hey, I want more bailouts, and you sent me checks directly the last time. Please do it again this time." Um, Understandably, they're just looking at their immediate needs. I got to put some food on the table right now. But I think that the average person might not really be aware of how this game, no matter how it runs, benefits those with assets. And the concern I'm detecting in your voice, which I share if you have it, is yeah, they're going to just run this playbook until enough of the masses say, wait a second, we've been following this playbook and it's just getting worse and worse for me. And then eventually, you get to some flashpoint. I'd love to say I've got a lot of confidence. There's some policy changes going ahead, or there's some political group that's really advocating for the real type of reforms we need. I don't see this yet. So until I see any of that stuff, I do have a concern that we are more or less on a timer. I don't know when the timer ends, whether it's, in 6 months or 6 years or 6 decades, but it seems pretty clear to me that if we don't veer off of this trajectory, we are going to hit that social boiling over point. Do you share that fear?
Yeah, look, I mean, unfortunately, I would love to say, okay, we have some leaders on the horizon that recognize the issues and are serious about addressing them. The system, as long as it's running the way it is and it's benefiting the people that are in charge, let's not kid ourselves. Um, they have no incentive for change because it works for them. Grasping at history here again, these changes only come when they're forced, when you have, unfortunately, some sort of horrific event that no one wants to see. Well, everybody says, oh my God, what have we done? We got to fix this. I don't want it to come to this, but the problem is I don't see anyone on the horizon. Just following up on this yield discussion we had, I off the top of my head, I can think of two reasons why yields could rise. First is to just acknowledge if you wanted to have a real inflation successful battle, you don't do it with ever easing financial conditions and ever higher screaming asset prices.
Right.
If you didn't really tighten, then this recent reduction in inflation that we've seen in the data may have been, basically just clearing the deck on supply chain issues, and you're setting yourself up for inflation to creep back up. Especially if you get into a situation when all of a sudden you have tariffs coming back into the political spectrum in a major way. Who knows, right? And so that is one factor, and the other factor is simply the supply demand equation. I just mentioned ever more deficits as far as the eye can see. Well, that is a driver of yields as well, and maybe this recent run up that we saw in yields was directly related to the massive debt increase that we just saw in the last 4 or 5 weeks. And that's why they're reintroducing more buybacks on the Treasury side, because they want to manage that equation. But right now there is a massive gap between the bond market and the stock market. And I think when you have imbalances like that, they can solve themselves peacefully, or you're going to get some sort of snap event. And maybe the election will prove to be that kind of resizing. I mean, I was seeing some CNBC report today that apparently everybody's all in stocks. Money market funds are at the lowest cash levels ever. The summer we saw a record ETF inflows. No one's bothered to sell in September, October because nothing ever dropped. And so you wonder about maybe what some risk factors may be, and maybe this is a good time to switch to bear porn portion of the segment.
Make the switch, buddy.
Okay, so before I'm accused of being a perma bear again, just draw back to the initial part of the discussion, which was liquidity, 10-year cycle, everything is wonderful, right? I mean, it's going to keep driving asset prices. But having said all that, and the consequence, I mean, I could make a valuation point. I mean, everybody's kind of throwing their eyes at valuations. I'll just throw it out just for giggles, I mean, being old school, maybe it's still relevant, maybe it's not. But I'm just pointing out that we are now officially in La La Land.
Hmm.
This is the old tried Buffett ratio. This was the printing here in 2020 and 2021. Then we had our little back cycle, and the 2000 tech bubble was suddenly the support level for this, and now we are back over 200%, which we've never had before. Certainly not on a sustained basis. And I know the argument, Max 7 global footprints, it is higher than it should be in previous cycles. Fair enough. Fact is, though, this market ain't cheap. I think this is just a simple recognition of what that is. And when I say not cheap, you're looking at price to sales over right around 3, which we only had at the 22 top as well. We're talking about price to sales ratios. The top 3 stocks combined market cap is $10.5 trillion, and they have a blended price to sales ratio of 19.
Yes.
That's mad. Okay. Go back to the 2000 bubble, 10 was just not even realistic in terms of returns down the road. That we have these type of price to sales ratios in the biggest companies on the planet, it's concerning. I'm just saying the market is not cheap. In fact, just throw in a classic traditional measure, which is GAAP earnings. Remember those general accounting principle earnings? And I want to highlight what's been going on here as a result of all this, backstop, and that is massive multiple expansion. GAAP earnings have improved since obviously the 22 tightening, but are they dramatically higher than they were then? No. Um, you know, we stuck around here in the low 20s during this corrective phase last year. We were even at 22 at some point for multiple, and earlier here this month we actually hit 30. Market is not cheap. Okay, so anyone wanting to buy here the year-end rally, which I'm not saying is not going to happen. So I want to be clear on this. I'm just saying this market is not cheap. You're paying for a lot of positive expectation going forward. Okay, and then there's this thing that is kind of on my mind mostly every single day, which is technicals. Okay, love technicals, and they are always of interest. So let me give you the bull case first here, because we talked about this in the summer as well, about this crazy S&P 9,000 type of view situation, right? And I love how clean these trend lines continue to be to this day. Remember, here's this cup and handle we talked at the beginning of the year, and boom, it just flew out of there. And you can argue we got the support trend line. Here's a trend line from 1982. That was the 2000 bottom, and it was the 22 top. And you can argue this has room higher. 5th-year cycle, no trouble until in the 10-year cycle until the latter part of the decade. In its most extreme, I can make the case for 9,000, right? But notice here all of a sudden this trend line here. This is going from the 2007 top. It starts matching up here. And these trend lines, we can all laugh at them, if you will, but I tend to not want to ignore them because they are so long-term relevant. I mean, here's another chart that shows it also in a more shorter time frame, which is weekly instead of monthly. I mean, take a look at this trend line. This is 2003, 2002 low. I mean, look how precise this is. This was here 2018 January. Then it was the 2020 top. Then we broke above it following all this printing. And notice it was resistance first, broke above it. Then we had that bear market. Guess what? It was resistance again. It was resistance again. Then we broke above it. Then it was support. August low, it was support. I mean, you look at something like this, you just got to stand in awe and say, wow, this has relevance to this day. It had relevance this year for the August lows. It's impressive, right? And, we're breaking above this, but now we're getting up to another key trend line. Is it relevant here? Too early to say. I mean, you need to see a specific reaction. to confirm it. But I'm just saying in general, these long-term trend lines have relevance, right? And if I look at this then in context of what markets have been doing this year, okay, I want to show you a couple of really freaky charts. The first one is to say, well, if I look at what the market's been doing on a high level, it's actually shockingly similar to what we've seen in the lead up to the last two larger tops, right? The lead up to the COVID crash. Now, obviously, no one knew COVID was coming as a trigger, but certain things happened here, and I'll refer to this again in another chart in a bit. But the key was final new highs on a negative weekly RSI divergence. Guess what? We had the same thing here into the 22 top, right?
Yep.
I mean, very clean, actually. Ding, 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 ding. And guess what? We just did it again. These highs that we kind of eked out here in October, again, tagging a trend line. Here's a shorter term time trend line, a rising pattern, very pronounced negative divergence, and we just had a break. So in principle, what that tells me, I can make the case we could have a major sell-off here into the weekly 50 MA, into this uptrend line. And by the way, if we did, it wouldn't be the end of the bull market. I mean, the bull market trend, this is what we've had since the 2020 lows, right? We dipped below it for a week or two last year. This was when Hamas attacked Israel, caused a little hiccups, but it held, right? And I'm just saying there is potential firepower for that to happen, and I'll give you a reason for that. Because anyone can look at this chart and say, well, this can just invalidate itself. Well, a lot has been made this year about equal weight all of a sudden improving. You may recall this. Lagging sectors, small caps catching up, da 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 da. Well, look at equal weight, the S&P in equal weight, and this is another one of those freak charts. Ready?
Yep.
Okay, well, here we go. Um, It did break out to new highs, broke above the 22 highs. Very positive, right?
Do me a favor, Sven. Can you expand that chart to take up more of your screen?
Like this.
There you go. Yeah.
Does that help? Okay, good. Um, I am impressed by how incredibly clean, again, these trend lines are. When you talk about a rising wedge, right? Rising wedges don't confirm until they actually break to the downside. But that new high also again on a negative divergence. It looks awfully similar to what we saw in the lead up to the 22 top.
Yep.
Same type of structure, and it went on for months. It went on all of 2021, right? As the S&P made new highs. I mean, it's very similar. We even saw that before COVID again. Very negative divergence, new high, and then lights out. So I'm just saying there are some risk factors here, and it's not all as positive as it seems on the equal weight front. New highs is positive, but then you always have to watch out for how this charts itself. And if you can get a flush down, then all of a sudden you can get a larger size correction in the equity markets. So I'm just pointing that one out. But here's my scare your mama type chart. This one has me baffled.
All right. Well, this
Okay.
is appropriate given that it was Halloween this week. So scare away.
Exactly. Yeah, trick or treat, right? Okay. There's another measure of equal weight, been watching it for years, and it's called the value line geometric index. And this one has me absolutely baffled. Do you see that in the right size?
I do. Yep.
Okay. Let me explain this chart. First of all, the value line geometric index, mentioned about that with you before, but it's basically a different way of measuring equal weight. You put everybody at $100 and then you track them relative to each other, as opposed to market cap based measuring. And what I want to point out here is that in previous bull markets, like here in the lead up to the housing crash, what you typically see is XVG rallying to new highs. along with RSP, which is another equal weight measure, and the market, right? They're aligned. There's more volatility here, but the message is the same. It's very bullish. And then when you have a low like here in 2009, things improve again. And we saw that again after 2013. It all went along the same way. And sometimes it compresses, and then we saw that breakout here. Well, here's the funky thing. We had the same thing again here into 2018. Again, I mentioned this then turned into tightening, and then the flip-flop. But when the Fed flip-flopped and cut rates and expanded the balance sheet here into 2020, noticed XVG, that measure of equal weight, while RSP and the S&P made new all-time highs, our XVG did not. In fact, it built in this major bear flag. It was massively lower vis-a-vis the previous high, while RSP and S&P just chugged along to new highs. That was weird. That was a non-confirmation of that rally. Now, we know it was COVID that triggered it. And then obviously it was everything, rescue and intervention, that brought it back up. And this is when we had the return of the relationship where everything went up, right? So all makes sense. And then we had the tightening cycle. And now we see again RSP making new highs. We see S&P making new highs. What is this on XVG? I
That's a
mean,
lot of chop.
it's a lot of chop. And notice how absolutely impressively clean this is a monthly chart, by the way, how clean this trend line is. Is this, I can't say that it is because nothing's confirmed, but if this is a bear flag, it's Mahuse. And I'm looking at this because, this was a big bear flag. This is even bigger, you know. Anyone that calls for bear market looks like an idiot in this environment anyway, so I'm not even going to try to do it. I'm just pointing this out. This is a chart I cannot explain. It's a chart that has me worried on the back end because there's complete lack of confirmation. If I want to say this is all valid and based on what we've seen in history, XVG should have been making new highs by now. I mean, this is what every other bull market cycle has said, with the exception here of COVID. And, something needs to happen here very shortly. So for that bull 5-year cycle to really take off, what we want to see is a massive breakout in XVG. And we haven't to this point, despite having seen this just really impressive rally over the last 2 years. So I think it's a big, big question mark that we all need to keep an open mind about. It's kind of a freak show as far as I'm concerned.
All right, freak show. Okay. So first we got to get past the uncertainty of the election. Then looking in the year ahead, at the beginning of this conversation, you said, look, if we look at kind of history and correlations and the spookily correlated year 1963 and the 10-year cycle that's in the Cynic's Guide for Markets, we could have another great year ahead of us. But one, that 1963 correlation, if that were to continue to hold, there was a pretty big summer correction in the middle of year 5. Now it ended, and then year 5 ended at a higher level, so it recovered. But you could say, all right, there's that potential downside risk. Then you're saying from these other charts that you just showed us, hey, there are some technical charts that show that, if history repeats itself technically, we could expect some bigger downside moves in the market here. Now, of course, that would have to overwhelm all the things like the rising liquidity and everything else that we're talking about. So, very much sort of a mixed bag here, a lot of question marks, and probably starting with the premise of, don't fight the trend. You got a lot of momentum at your back, a lot of reasons for things to still be good from here. So I don't hear you telling people get out of the market, but I guess I hear you say, if you're going to continue to be long for the market, and that might play out for you, you need to be aware that there could be some surprising drawdowns. I guess there's data to suggest there's a higher risk of surprising drawdowns next year than we've had over the past couple of years. So how are you planning on surfing that as a guy who's advising clients here?
Well, I mean, as we discussed on the outset, we have periods when we really like risk reward and we're pushing aggressively on the long side. And then our process is to build flexibility, when these setups play out and we get into very overbought type conditions and see divergences building and maybe a bit too much enthusiasm on the side of the market, we scale out, we build cash, and then we have the flexibility to react again. I mean, as much as it seems markets are going straight up, there are technical moves to be had. And August was a classic example of that. April was a good example of that. So we stay active in these markets. Now, I'll tell you what my base assumption is,
Hmm.
in terms of where we are. There's a couple of outcomes, obviously, and I don't want to handicap all the different possibilities, but let's say, for example, we do get a smooth election, clear winner, everybody shakes hand and happy. I think this would be immediately regarded as a bullish outcome.
Hmm.
Because let's face it, no matter who wins, the fiscal dominance equation will continue. Deficits will going to be there, buybacks will be there. And for example, Europe right now, there are concerns in Europe about, frankly, if Trump were to win, they're concerned about tariffs.
Right.
And the ECB this week, actually, one of their speakers said that they're prepared to deal with this from a monetary perspective if that were to happen. The election is closely watched. And so, example, if Trump were to win, I can certainly see where Europe may react negatively. Likewise, if he doesn't win, Europe may react positively. Just throwing that in there. On the US side, it may be a completely different reaction, right? Because we may see more tax cuts or no taxes at all, depending on what comes out. My principal view is, though, if there's a clean election, it would be immediately regarded as bullish, even
Hmm.
though that it may cause some trade unwinds. For example, if there was certain trades dependent on Trump to win, i.e., the tax cut situation, then if Harris were to win solidly, that some of these trades may unwind and that may have an initial hiccup period. That's possible. A contested election, I think, would be creating a ton of uncertainty. If it gets ugly, then this could be a trigger point for a larger correction than maybe we all have in mind. I would just general say markets are so expensive that technically, and there's a lot of room for a sizable correction. That lower uptrend line from the COVID lows, 15% correction. I'm not predicting it. I'm just saying the room is there and it wouldn't ruin the
Yep.
bull market necessarily. I'm just saying there's going to be a wide range of possibilities. Now, we have a trade plan. We have specific levels that we are watching, shared that with clients, for confluence, for testing positions, but also know about the lower risk levels in case those levels don't hold. So we have specific technical areas that we're looking at. There's also an argument to be made, for example, per that 1964 analog, that any correction will be really minor. And I'll give you a technical reason or two technical reasons or charts for why that may be the case. So this is going to be one of those mind benders.
Hmm.
We've been making new highs all through September and all through October. We just pulled back 3%, and you're not going to believe this, but we are already oversold. It makes no sense whatsoever. Here's one of the oversold. I mean, this is where, I've had, it's the cringe factor this year, I have to say. Okay. This is one of the signal charts I use for larger directional moves in
Hmm.
terms of when things are getting overbought, when they get oversold. This is the McClellan Summation Index. And for the last few months, it's really been a head scratcher because it made very little sense on some levels. I mean, April, when we had that pullback here into the weekly 20 MA, by the way, weekly 20 MA has been basically support all year, right? There was one little dip here, obviously that August low, but here was the April correction, tagged it perfectly, and guess what? We were in sync. We got an oversold signal on the stochastic on the NYSE. You know, you get these oversold things, you know, like last October, we were oversold on the stochastic. The October before, we were oversold on the stochastic. And that stochastic can be oversold for several weeks. So don't take it as a day trading signal. But you know, it was oversold in April, and hence, given the confluence support with the weekly 20 MA, it made sense to buy and try to test some longs, and that worked out nicely, right? And then we had another little oversold reading here in June, which made little sense because we had barely corrected at all, right?
Yep.
There was not much going on. But when we then did correct hard in August, it didn't even show up as oversold. Why? Because this correction was reverted so fast, so aggressively, it could never really show up in the chart. And then even in September, when we had those 3-day pullback, there was nothing there here. It just didn't even really show up, right? But now we are 3% from all-time highs. Not even now, as I'm looking at the tape now, it's maybe 2.5%. And this thing is already back to max oversold. Are you kidding me? What that tells me again is that we've had, again, a rally a lot driven by the Max 7, and there was churning underneath the market. And I have a second chart to back that up. This is another one of my favorites. It's NIMO. I'm sure a lot of you guys are familiar with that chart. NIMO is also one of those signal indicators. And guess what? It's back to minus 62, which is nearly the August low level. Which is lower than it was in October of last year. That was a positive divergence. It can go lower, absolutely. So let's say, for example, you come out of the election, all of a sudden you get another 2, 3, 4, 5% down. This thing would be fried to the downside, like a minus 100 reading like we had in April. So I'm just saying, we're going into this election actually more oversold than it seems, because this is not a big down move at all. It's just a standard fare type pullback. Second point I want to make on this chart, Adam, is how bizarrely weak this has been in October. It was only just a couple of days where it's barely positive. You know, typically when you make these new highs, you get some nice positive readings. I mean, most of October, while the S&P made new all-time highs, this has been in the red. Very
So does
funky.
that make you more worried or more optimistic? Like the market's strong enough to overpower that weakness, or does it make you think that the market's kind of hanging on by its fingernails?
Well, my best guess here, the interpretation is that, again, the market actually has been correcting underneath, and that this strength here was an illusion.
Okay.
You know, typically we have weak seasonality in an election year. And ironically, a chart like this actually reflects that. So keep in mind, the other thing that's happening here very shortly, one thing that was really amazing, and this goes back to this massive debt increase that we saw from late September into late October, is that one liquidity component was missing here, and that was buybacks. So the market rose despite buybacks being gone. Well, guess what? They're coming back.
Yep.
Okay. So they will again be a liquidity support factor here. And so knowing that and saying, well, maybe the strength was the illusion in terms of the price presentation, but it's been so held up by the large cap tech that there are actually signals in the market that say, if you do get downside, and while there is valuation rationale and technical rationale for that downside to be vast, it could also be very limited, like in 1964, to like a 5, 6, 7% pullback, and that's it. Because then you would get oversold more dramatically very quickly. I know everybody would probably hate listening to this, me saying that, but I'm just going by what the chart says.
Right. And you get both the oversold extreme plus the buyback spigot getting turned back on. So, yeah.
I have one more plot twist here for everyone because I hope you like plot twists.
At the edge of my
Um,
seat here, buddy.
huh?
I'm at the edge of my seat here. Can't wait to see how this turns out.
Because ironically, what I mentioned is recently Mac 7 has been driving the rally and the market's been correcting underneath. Well, funky that because NDX has failed to make a new high, right? I mean, we just had several of the big cap tech companies reporting and NDX is selling off. Now, NVIDIA is still coming. I guess S&P 1, we're kind of depending on that again. But so
S&P
far, the
1.
NDX has not made a new high, while the S&P has on a negative divergence, as we discussed. Guess when the last time was that we saw that? Right here.
Yeah.
22 January, S&P made a new high, negative divergence. Guess who did not? NDX.
NASDAQ. And then we had one of the worst years for both stocks and bonds together. Yeah.
Right. Now, again, this was tightening here, but I put it in context of this unresolved issue we have now. And I think it's an unresolved issue for every participant in the market. Why is the 10-year as high as it is? Now, there's even some people that say it's because they expect a Trump win, and that's why the 10-year is going so high. Okay. I don't know if that's the case, but maybe it is. But then, for example, if Trump were not to win, then if that's true, then the 10-year would just collapse, right? And that would actually be massively bullish, you would think. I, I'm not saying all these explanations people put forth make structural sense. I'm just saying there are some people that are explaining it in a certain way. I'm just saying at this point, along with equal weights, the RSP and the XVG that I mentioned, here's another checkpoint that says, well, you know, this this all of a sudden could have room for a sizable move down. And again, it may not be the end of the bull market, but there's just warning flags here. And I'm frankly struggling with this because, you know, back then when this happened, we were not oversold after 3%. This is just very unusual. So what I'm saying is, I'm prepared to respect the signal charts and say, okay, we're going to test this level, a confluence level. Like for example, yesterday was clean. We got a 50 MA attack on the S&P. We got a 50 MA attack on the DAX in Germany. Perfect synchronicity, made sense to see a bounce from there. Whether that bounce then holds is a completely different situation. For example, for the first time in many weeks, we're now dropping below the weekly 5 EMA. You and I are recording this on Friday. It's half an hour before the close. As I'm looking at the price data, we are currently below the weekly 5 EMA. That's one of those control pivots. Again, hasn't been broken for a while, but that suggests there's more downside risk, obviously, into the election next week. And then that could trigger something. So my view is obviously need to see the reaction of the election. If it's protracted in terms of uncertainty, it could become a complicated correction, meaning like something like we had last year, stair step down until there is certainty. Once certain uncertainty is removed, boom, relief rally, right? So unfortunately, we are in a situation where we are event dependent. We don't know the outcome of the event, but we can be reactive if you have flexibility to be reactive. Like in August, like in July, we made the decision in early October to close out longs and have that flexibility. So far, that range in the mid-October with these new highs has not yielded any follow-through. Now we have a breakdown below that range. So from our perspective, it's been the right call. We're testing now gingerly some areas, but we're very disciplined with stops, and we got tons of flexibility to react to different levels that we have in mind if and when something breaks. But given the signals, given the liquidity, Expectation is that whatever low we get is likely to get bought into a year-end rally. And then we have to ascertain, is there going to be tax loss selling again? People locking in gains if they expect a different tax regime. There's all these type of consideration. So my principal assumption is if we do get a correction, whether it's minor or larger, it's going to set up for buy still into the 5th year of the cycle. And we should be respectful of these valuations and these larger technical trend resistances because they obviously leave the door open for a larger pullback. But ultimately, I think the liquidity regime with ongoing fiscal dominance, with rate cuts coming and record buybacks is continuing to be supportive of equities into next year. And there will definitely be some hiccups next year, i.e. 1965, where we're going to set up for another larger correction that we can then also buy. Yeah, if I sound like a little permeable here, for now, I respect that 5-year cycle because there's not been a single 5th year in the last 120 years that didn't have new highs. And then trouble came in the second half of the decade.
The decade. Okay. So what I hear from you saying, Sven, is, hey, in the short term, be careful. We got to get through the election, and the election results could trigger, some sort of downside correction, maybe even a bigger one than people think might be possible. Once the dust settles from the election, as you're looking towards the end of the year and into 2025, by to sum up what you're saying is it's be bullish, but be cautious, right? And we've had a lot of people on this channel over the past year plus saying, we're increasingly in a regime where an active approach is going to be needed more and more. And I think that that's very much, you're nodding as I'm saying this, very much your camp as well, which is while you'll still be, until the signs change, you'll still be bullish, but you're going to be, probably lightening up, waiting for dips, getting back in, letting some of the hiccups that you're expecting, the greater preponderance of hiccups or frequency of hiccups you're expecting, really trying to surf those intelligently rather than just to blindly, okay, I'm just going to buy the market and hold for the next year.
Yeah, and even Goldman Sachs came out, I think, recently and saying their 10-year expectation going forward is much lower equity returns.
Right, and that's because of the stretch valuations that you've been talking about. Yeah, exactly.
Yeah, I mean, I know in an environment where everything keeps going up nonstop, I think we're all kind of numb to the notion of, no one even expects a larger correction. I mean, it always happens that way, and valuations are ignored because they don't matter. I mean, it's literally that sentiment every single time, and we are at levels that we have just simply never seen before. On some levels, I mean, I can cite all kinds of ratios and this, that, and the other, but I would say you're asking more and more of the market to ignore, to be able to sustain sizable further gains into literally uncharted territory. I mean, I have no problem with even S&P 9,000, as I mentioned earlier, but do I want to chase here in this valuation construct with the 22 forward multiple with new longs? No, I mean, look, as I said, we've been buying long all year long. We've been buying dips. Great year. Happy about that. There is also something called patience. Zero FOMO on my part. I would like to see some valuation pullback, get sentiment a little shaken up, get some better valuations, and then pull in. The regime that is in charge has up until now prevented that, right? And you're basically forced to be long into this high valuation construct. I don't like it, but I recognize for what it's at. So, I want to be flexible, and we're going to continue actively trade through these markets, and we're going to have periods when we're patient, like in July, okay, that's it now. Now we wait, and then we get the pullback, and then we can get active again. That to me is, I think, a very reasonable way to approach markets, going into next year, and maybe perhaps beyond. As you know, we have these issues that need to solve themselves throughout. We are continuing to be dependent on, unfortunately, to keep the construct growing as it is. And I see this all the time with the media. Every time you celebrate new market highs, you're celebrating more wealth inequality. It's not a breaking issue yet, but it keeps gnawing. It's a bit of a concern. We can't change the world, but we can only be as practical as we can be, and we keep using technicals to navigate through all this as best as we can.
All right. Well said. Look, I got to wrap up here. I'm looking at the clock. We're already at the hour and a half mark. I love having you on, Sven, because you just put everything on the playing field. Now, for a lot of folks who have been listening to this, they're probably thinking, "Wow, all right. Well, how do I actively surf what may lie ahead from here?" And folks, if you want to look over Sven's shoulder and see the trades that he's making, there's a service to be able to do that. So Sven, for folks that would like to follow you and your work from here, where should they go?
Well, I mean, I have my public feed where I share information publicly, including the YouTube channel, Northman Trader, trying to, you know, keep it straight up in terms of what I see. Obviously, people are always free to disagree, if you will. So that's why I share some public information in terms of how we are approaching it, positioning wise, and staying abreast on the technical developments in terms of also levels where we get active. You can see that via the website if you sign up with a daily market brief or live alerts or market videos. And that's where we got our merry group. That
All right.
is,
And you're also quite active on a daily basis on X, just letting people know what catches your attention. So Sven, when I edit this, I'll put up links to your YouTube channel, your website, and to X so that folks know exactly where to go. Folks, those links will also be in the description below this video. Well, folks, if you've enjoyed this, would like to have Sven come back on again next time in the future where he sees something that's causing him to make perhaps an audible change to what he shared with us here. Let him know you'd like him to come back on the channel to do that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And if you are less of a DIY person, but would like some help in actively managing your portfolio, if you don't already have a good financial professional who's a professional financial advisor who's doing that for you, then consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses and listening to see how they think, what they recommend you could do with your portfolio, given your specific goals, risk tolerance, and needs. Just go to thoughtfulmoney.com, fill out the short form there. It only takes you a couple seconds. And one of the firms will be in touch with you very quickly to schedule one of those consultations. And as a reminder, they don't cost you anything. There's no commitment to work with these firms. There's no strings attached. It's just a free public service they offer. Sven, my friend, it's always wonderful having you on here. I like to give guests the last word. Any parting bits of advice for the regular retail investor who is just trying to grow their wealth here without becoming collateral damage to some of these hiccups that you think might be happening?
I always like to say stay flexible and open-minded. I mean, and beware of the super extremes. I posted a SMCI chart this week. That was an update from February. I mean, remember this massive just melt up scenario that it was great for people to catch, but it was horrible for people to get caught up in. Understanding markets it's important to get a feel for the broader picture, what drives them. That's why we like technicals and they're helpful tools. And this investment climate that we've had, if you hadn't done anything in the last 2 years, you're happy as a clam, I'm sure. But keep in mind, markets don't always go up forever, and there will be challenges in markets. And that's not something to fear, but it's something one wants to be able to take advantage of. And that's why we believe in building flexibility when the signals tell us to do so. And that's why we like an active approach in markets. It's fun, it's challenging, and sometimes frustrating too. But it's what we love to do. I mean, I think markets is one of the greatest professions anyone can be involved in because it's always interesting. There's always something to learn, and it can be a lifelong journey, as it's kind of shaped up to be for me.
All right. Well, well said, my friend. Sven, thanks so much for coming on. Like I said, for just leaving it all in the field. Everybody else who's made it here to the end, thanks so much for watching.